Looking for better returns than what your bank FD offers? Tempted by the idea of fixed income investments that feel safer than the stock market? Platforms like Aspero are now pitching exactly that, higher returns with seemingly controlled risk. But it raises some important questions. Is this really the best of both worlds, or are we underestimating the risk that comes with higher yields? Can newer platforms deliver on their promises without compromising safety or liquidity? Aspero claims to offer a fresh approach to fixed income investing. But before jumping in, it's worth asking, what are we really signing up for, and how does it fit into our broader financial picture? Hi there, welcome back to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So now let's get into the video by understanding the bond market first. Have you ever lent money to a friend and expected it back with interest? That's essentially what a bond is, but at a formal level. Bonds allow governments and companies to borrow money from the public, promising to repay with interest. But what makes this market tick? Why is the bond market called the backbone of the economy? And if it's so important, why don't more retail investors participate? The answer is simple. Lack of access, awareness, and ease of investing have historically kept retail investors away. Platforms like Aspero are now trying to bridge this gap. Now, what is a bond? At its core, bond is a loan made by an investor to a borrower. The borrower agrees to pay back the principal along with periodic interest. Simple, right? But what if the borrower defaults? How do bond prices change with interest rate? And can you sell a bond before maturity? And if so, how easy is it? These questions show why understanding a bond's terms, ratings, and liquidity is essential before investing. Now, let us take a look at government bonds. Think of these as the gold standard of debt investments in India, issued by the Government of India. They offer unmatched safety. But can they beat inflation? And how easily can you liquidate them? Is the process user-friendly for retail investors? Are there any hidden costs or liquidity traps? While G-Secs provide safety, they may fall short on liquidity and returns, making them ideal for conservative investors. So the minimum investment is 1000 rupees in multiples, and you can invest through RBI Retail Direct Portal. Now let us take a look into private or corporate bonds. So why were corporate bonds out of reach for so long? High entry barriers. But now, with SEBI lowering the minimum of 10,000 rupees, retail investors have new opportunities. Still, key questions remain. How do you judge which corporate bond is trustworthy? Should you only go for AAA rated ones? Do higher yields always mean higher risk? How do you check a company's fundamentals or debt servicing history? Corporate bonds offer attractive yields but demand careful research and risk assessment. Now, would you lend your money to someone without knowing their repayment capacity? Probably not. That's where credit ratings come in. But how reliable are these ratings? Have there been defaults even among high-rated instruments? Should a downgrade worry you? Can a single rating capture a company's true financial health? Credit ratings are a useful starting point, but they are not the whole picture. Look at cash flows, business fundamentals, and industry trends to understand the entire picture. Now, in the screen, we have presented a quick list of the major players. But do they all rate bonds the same way? And how often do they update their ratings? And could conflicts of interest arise since issuers pay for ratings? And that's why you need to check ratings across agencies and stay updated, especially in volatile markets. Next, in the screen, we have also presented a simplified rating scale for your reference, which you can pause and see. Now, not all debt is created equal. Bonds vary in safety depending on what backs them. So, senior secured bonds are backed by collateral. So, that's the safest. Senior unsecured bonds have no collateral, which means it it has higher risk. Subordinated bonds repaid only after senior bonds, so it also has higher risk. But perpetual bonds have no maturity, meaning it has the highest risk. So if the issuer goes bankrupt, who gets paid first? Can you recover anything? Does collateral actually offer real protection? So for conservative investors, prioritizing secured over unsecured debt is often wise. Now let us take a look at the Aspero platform's overview features. So Aspero operates under SEBI's online bond platform provider framework. But what does this regulatory backing actually mean for you as an investor? Does it guarantee complete safety, or does it merely ensure basic regulatory compliance? How transparent is Aspero in highlighting investment risk? Can you depend entirely on the platform's filters to make informed decisions? While SEBI's oversight offers a safeguard against fraudulent practices, it does not eliminate the risk of defaults. Hence, investors must conduct their own due diligence before committing to funds. Now, what are the key features of the Aspero platform? It is fully compliant with SEBI OBPP guidelines and offers returns in the range of 8% to 14%. It has a curated selection of senior secured bonds rated from AAA to BBB, and it also has zero transaction fees or commissions, and there are flexible investment tenures available from 6 months to 5 years. And what are the product offerings? So senior secured bonds from sectors like infrastructure. In infrastructure, they have National Highway Infra Trust, and for NBFCs, they have Akara Capital, Indal Money Limited, and for finance, they have Satin Finserv, Muthoot Mini Finances, and utilities, they have Crisp Financial Limited. And fixed deposits are from Mahindra Finance, Suryodev Small Finance Bank, Bajaj Finance, Shriram Finance, Unity Small Finance Bank. So interest is typically paid monthly, quarterly, or semi-annually. But are you missing out on the power of compounding? Would manually reinvesting help maximize returns? Could a growth option like mutual funds be more tax efficient? What happens if the issuing companies runs into cash flow issues? While fixed payouts offer regular income, they may not suit investors aiming for long-term compounded growth. Reinvestment discipline is key. So what are the minimum investment requirements? For bonds, minimum investment is 350 rupees and the minimum tenure available is from 9 months. And the minimum interest payout frequency is monthly. And for fixed deposits, we do have a tabular column presented on the screen for your reference, which you can pause and see. Now, what are the key considerations? Are these amounts feasible for your financial situation? What percentage of your portfolio should you allocate here? And should your emergency fund be parked here? Probably not. Small ticket sizes improve access, but only when they align with your broader financial strategy. So what are the platform features? Seamless web and mobile interface, filters to search by credit rating, tenure and yield, and investments categorized by risk return profiles. But a user-friendly interface has its limit. Can it detect underlying risk? Are you over-relying on filters without deeper analysis? Does the simplicity mask complex product structures? Convenience should support, not replace investor awareness. So who should consider Aspero? Investors comfortable with higher risk in debt, aggressive savers seeking enhanced returns, those with small experimental capital for diversification. But ask yourself before investing, can you handle potential defaults? Can you afford to stay invested until maturity despite liquidity constraints? What's your contingency plan if the platform changes hands? Aspero works best for investors who have already met essential financial goals and are willing to take calculated risk with non-traditional debt products. So here in this tabular column, we have in detail listed the tax implications of investing in the listed bonds, unlisted bonds, interest income and fixed deposits this platform provides for you. So which you can pause and see. So now let's take a deeper look at the risk, because Aspero says their bonds offer zero defaults. Sounds promising, right? But remember, equities, especially mutual funds, can be volatile. Markets may fall 40 to 50%, but they recover. Your capital loss isn't permanent unless you sell in panic. So contrast that with bonds. If the issuer defaults on payments or principal, that's a permanent loss. We have seen it before. DHFL 2019 1,500 plus crore defaulted. ILNFS 2018 91,000 crore default. S Bank 81 bonds, retail investors lost everything. Even senior secured bonds carry credit risk. Collateral isn't a guarantee. Meanwhile, equity mutual funds offer you diversification, liquidity, professional management. So instead of asking which is safer, ask, can I handle equity volatility? Am I prepared for illiquidity or default risk in bonds? Does my portfolio balance growth with safety? So in April 2020, Franklin Templeton shut down 6 debt mutual funds, freezing over 25,000 crores. These weren't bad funds. They had consistently beaten FDs, but a crisis triggered panic and the bond market froze. Investors were locked out of their own money. If a reputed AMC like Franklin could freeze funds with SEBI oversight and daily NAVs, what about platforms offering unlisted bonds from lesser known issuers? No regulatory NAV, no secondary market liquidity, no guarantee of principal. So, what is the final takeaway from this video? Aspero earns through markups, not transparent fees. Always cross-check the final yield. Past performance doesn't erase real credit risk. SEBI oversight for OBPPs isn't as stringent as mutual funds. There's no skin in the game. The bond market is illiquid. Finding buyers isn't guaranteed. So instead of opaque products, consider SEBI regulated credit risk mutual funds with instant diversification, daily NAVs, full transparency, professional fund management, and liquidity. Or for sovereign safety, consider RBI Retail Direct for G6. So Aspero offers a modern tech-enabled route to high-yield fixed income products. But while it simplifies investing, the underlying risk remains significant. Only allocate funds you can afford to experiment with, never at the cost of liquidity or core financial goals. Your investment should serve your life goals, not just chase returns. So are you ready to make smarter investment choices? Then click the link in the description for a free consultation with one of our certified financial planner who can help you build a diversified, transparent portfolio. Match your risk to your goals, invest with clarity and confidence. So don't forget to like, share and subscribe for more insights like this.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.